That was also a very interesting experience where I randomly got a call from Zach, who was the former senior counsel of the SEC, and he was like, "Hey, it's Zach. I'm from the SEC. Give me a call back." I literally thought we were in huge trouble, but luckily he really believed in what we were doing and now is our legal advisor.
Welcome, everyone, to our Hero Capital Show. I'm your host, Tim Mai, and today I have another amazing guest on the line with us. As young as she is the founder of Fractional app, which is a platform, an investment club platform that allowed capital raisers in all different industries and all different niches to be able to raise money that you need from friends, family, from your community. And it's a bit different than the kind of raises that we talk about with Regulation D in most of our real estate syndication deals or even regulation crowdfunding. So I'm super excited to dive into this investment club type of structure as a vehicle to raise money. Fractional itself has raised, I believe, Stella, correct me if I'm wrong, facilitated over $600 million dollars in the last 5 years. And interesting fact, Fractional is a VC funded platform, and Stella has raised over $20 million dollars to launch the platform. And so super excited to talk about both of those aspects today. So, Stella, thank you so much for jumping on with us today. And we're looking forward to learning more about your platform and all the cool things that you guys do on there.
Super excited. Thanks for having me, Tim. And I didn't know you had a fan club going on here, so you gotta let me know how do I get into that after this.
Yeah, Trevor's so sweet. He started the club. But so yeah, share with us a little bit about Fractional. Or actually a little bit about you. How did you get into this of investment club and just investing in general, and then your idea of starting Fractional?
Yes, definitely. Hi, everyone. I'm Stella. Super excited to be here. I am a real estate investor myself as well. Started investing in real estate a little bit over 8 years ago now, primarily out of state, out in the Atlanta market. I'm personally based out of the San Francisco Bay Area where it costs $1 million to buy a shack. And that was not the kind of money that I had, which is why I went out of state. Initially started buying single family homes with my own money, started stacking that up. And I think all of us here eventually reached a point where we want to do bigger things and we don't have enough of our own capital to do that. So then we start thinking OPM, right? Everyone talks about that. Everyone in the communities that I was in, they advised me, okay, if you want to go raise money for this portfolio of duplexes that I was looking at, pretty much your only option is doing a syndication or a fund. And a syndication was the more suggested route. So then I started also looking into, do I do a 506B or do I do a 506C? And my main issue was I was primarily raising from family and friends. This is the first time that I was ever raising money. Most people were not accredited investors, so I pretty much had to pick the 506B route and then figured out afterwards that I couldn't do any sort of marketing, right? So no posting, no soliciting, all that. And that raise ended up being a total shit show for me, where I paid an attorney, a securities attorney, a lot of money to set up all the documentation, the PPM, the filing, all of that. And then I didn't know better. It took 4 weeks to get all of that set up. So I already got the deal under contract. I didn't negotiate long enough of a time to raise the money. So by the time all the filing and documentation was done, I had 2 weeks left to raise all the money and I couldn't pull it off. So I ended up losing 55 grand on that deal in the legal costs for now this documentation for a deal that no longer exists. And then also my EMD that I put in on the deal. So that was my first time raising money for real estate, completely crash and burned. And at one point, I even thought maybe raising money isn't for me. Like, I don't get to do bigger deals. Is this it type of thing? And I think entrepreneurs, right? Like, we don't take no for an answer. And that was just not something that I was okay living with. And it really made me start to reflect and think about my life outside of real estate. So I used to be in tech before I went full time into real estate. And what was really fascinating was that a lot of my friends and I, we formed something called an investment club to pool our money together to go invest in stocks and crypto and even startups, like what we thought were going to be the next unicorn businesses, right? Like Meta and Google. With an investment club, what's really interesting is because all of us pooled our money together over a shared strategy and investment criteria, and we would then look at different opportunities together and then collectively decide how we wanted to deploy the capital that's been pooled. The SEC does not view that as a security. And that's really when I had that light bulb moment where I was like, how come when I was raising money for all these other asset classes, I didn't have to go find a securities attorney and be forced to choose between a B or a C and then deal with all the red tape around accredited versus non-accredited, marketing versus no marketing, all of that. And that's really when I saw this opportunity where we could really take this investment club model, which I'll explain in deeper details in a bit, into the real estate world. And that's pretty much how we got started with building Fractional as a company to help people raise capital from anyone legally without having to set up a securities filing and all of that. And that's how the idea of Fractional was born.
Wow, that's amazing. I love that. I love the just the need to solve your own problems, right? Like you got this deal, like all the challenges you went through it, lost money on the deal, and then relating it to something that's similar that you are doing in other aspects of investing and tying them in together. Fractional itself, what type of deals have been raised on there?
Yeah, that's a great question. So, the way I think about it is there is a tool and legal structure that will give you the most leverage depending on how much you're raising and who you're raising from, right? With an investment club, the biggest unlock, in my opinion, is that you want to be able to raise money from anyone without the red tape. And the key difference between an investment club versus a syndication or a fund is active participation. That is the main reason why the SEC does not view investment clubs as securities and why they don't regulate it, which is why like voting and deal selection needs to happen as a club, right? So when you take that into consideration, then it makes you think, right? Who wants to invest with you where having some form of small active participation is a win versus who wants to be completely passive. So where I've really seen the magic happen is if you're raising, let's say, $5 million or less, you have a lot to win by raising money from both unaccredited and accredited investors. And they really see like having a seat at the table as an elevated experience for why they want to invest with you. That's when an investment club is great. So we've seen people do it for private money lending. I saw earlier Emma mentioned she's in the hard money lending space and she's raising money for that, right? So that's a very common use case right now is people raising money from others who also want to be lenders and then they're essentially like interest arbitraging. That's very popular right now. We've seen co-living, commercial, self-storage, hotels, smaller multifamily. Really, $5 million or less is that sweet spot that I see. If you're raising more than that, a lot of times you're looking at like 100 unit, 1,000 unit apartments, right? Where you really do need GPs that are operating and doing all the decisions and then completely passive LPs. And when that happens, that obviously is a security and you do have to go the traditional route. Like you're not gonna raise institutional money raised from family offices and ask them, hey, can you vote on how our money is being deployed, right? Like they're just not going to be interested in that. So that's really how, in my mind, I see the differences on what makes the most impact.
Why the $5 million limit? Is that a legal limit, like the way Reg CF is, or is it just an estimate based on how many people can be in an investment club together and still have the active participation?
Yeah, the 5 million is an estimate from who the investors are likely going to be and what their minimum check size is and all that. The legal maximum for investment clubs in terms of members is 99 members. That's the limit that the SEC has set. An investment club cannot have more than 99 members.
Okay, so what defines as active in an investment club, besides voting on how to use the money and the deals that you go into, if someone is a syndicator, for example, and they're like, okay, I want to try my deal. This deal is small enough. I want to try the investment club, but I still want to limit what the members of the investment club can decide on. Yeah, like where's that balance?
Yeah, that's a great question. So, with an investment club, we definitely don't see active participation as like all of a sudden all your investors have to go in and fix toilets with you and deal with day-to-day operations, right? That's not what we mean here by active participation. What the SEC is really looking for is, are investors in a club participating in material decisions that the club is making as a business? So, the easiest way to break that down and have that active participation is essentially like front loading it into the investment decision itself, right? So when you think about active material decisions an investor could make, the front end of it would be things like, underwriting, doing due diligence, and ultimately after doing those two things, deciding whether or not a deal makes sense or not for capital to be deployed. That is probably the easiest active participation that you can have, which is why we always suggest that as like the key part that investors in a club could have. Obviously, like there's other things too. Like I've seen a lot of clubs that work on hotels, for example, where marketing is like another really easy win, right? Like the more people that are investors in your club and they can market the hotel you all bought together, then the better publicity you get anyways, right? So those are things that are like later in the funnel that people can actively participate in, but the easiest win is always around deal selection. So the way things work in a club is you start out with your club criteria, right? Let's just take hotels as an example, right? It could be my hotel buy box is we're purchasing in this price range. It has to hit this cap rate, cash on cash in this market, whatever it is, right? That now becomes the criteria for your club. And then similar to a fund, this is actually where you raise the money already. You now tell everyone in your network. And because an investment club is not a security, there's also a lot more flexibility when it comes to marketing. Obviously, like no saying dumb things like guaranteeing people returns. You can talk about this on your Facebook and on your Instagram and all of that, right? So you share your criteria, you raise the money from anyone who's interested in being a part of this criteria. And then what happens next is you then, as the club leader, you would bring opportunities that fit this club criteria back to your members and say, I found this deal. I think it meets our criteria for XYZ's reasons. What do you all think? Are we good to deploy the money? And then everyone will vote on whether or not they agree. And as long as a majority is met and a quorum is met and the club as a whole approves of the deal, then the capital is deployed. So everyone taking on that action, that is the material decision that they're being involved in.
I see. Okay. Now, if the bulk of their active participation is on the front end in deal selection and vetting, that's sufficient enough for SEC?
Yeah.
Very interesting. Okay. You mentioned about the $5 million limit, and I want to see what's possible. Let's say it's a $20 million raise, and I want to see two different scenarios. Number one, can an investment club come in as an LP in that deal? And number two, if the if the deal sponsor is willing to let the club come in as a small co-GP on the deal for that 5 million or that 2 million or however much that is that the club is bringing in, the check size the club is writing, which of those options is available for an investment club structure, or are they both available, or what's the limitations?
Yeah, that's a great question, Tim. And that's where it does become very complicated and there is more gray area, right? So the first thing to look at is who are the investors in your club, right? If you have a mix of accredited and unaccredited investors in your club, then it becomes tricky what larger syndication or fund they can invest in, right? If the larger one is a 506c, then that likely will not work because you've got
Mm,
unaccredited people in your club, right? So that is usually like the gray area we will generally tell people to just avoid. It's just not worth it at that point. If you
hmm,
have a 506b, you could potentially have your club be one of the investors in the 506b or work with a larger group or you have a separate JV, for example, between the club and the larger syndication, essentially.
Okay, so let's assume that it's a 506B, and let's assume that there were room for non-accredited investors to come in. We'll make those assumptions. So the club can just be an LP in the deal, in a syndication deal. They don't have to have GP position in the syndication deal. Is that correct?
Yeah, they don't have to be a GP in the deal, but you still have to make sure from an investment club perspective, that isn't a security. So it's still the same setup where they came in because they believe in a criteria, and the criteria could be like, we're going to look at larger multifamily projects. Then you would bring in whatever is the larger project that everyone is going to consider. Everyone will look at that opportunity together and then decide, okay, we're going to go invest in this bigger project as an LP.
And would it also applies the same way if the club is able to come in as a small co-GP in that deal?
Yeah, exactly.
Okay.
You always have to
And
make sure the club made the active decision to whatever group decision.
because I wonder if they come in as a co-GP, would the 506C offering still applies to the club members since they are on the GP team? I'm curious. Chrissy's shaking her head no.
Because you can be a GP and be non-accredited. By virtue of being a GP, you are accredited. You are active. And when I first GP'd on deals, I was not accredited, but you become accredited for that deal specifically. So that is a way to backdoor everybody in, but understand the liability that you're taking on.
Mm.
As
How does the club leader get paid? Can they charge a certain fee to the club?
Yes, they can. So anything that is, you can basically charge anything that is market rate. That's basically how the SEC sees the club leaders as basically just being compensated for whatever services or value they're providing. So let's say with any sort of commercial property, right? You can say, I'm putting in more work. I'm bringing deal flow to us. Can I get compensated in sweat equity? Or can I get a market acquisition fee, for example? Private money lending, we've seen people put like a profit sharing agreement in place where their interest arbitraging, right? It could be you're actually lending to a borrower at 20%. And then you, as the club leader, you say, hey, I'm bringing the deal flow. I'm helping our group be successful together and helping everyone underwrite. Can I get 8% of the 20% and you all get 12, right? You can put all of those things in place. That's fine. What is not good is having essentially performance-based compensation, because the moment something becomes performance-based, it starts leaning on this looks like a security, right? If it's like,
Mm,
hey, if we meet 12% returns, I get this bonus bump or whatever, right? Like that now becomes, I'm the one doing all the work to give you this return, hence why I'm being compensated for it. So
I see.
yeah, exactly. You want to stay away from performance-based compensation and more profit sharing agreements, JV, sweat equity, or just charging whatever is market for the service or the value that you're providing.
Right. There's a mindset shift here from the way that we look at LPs in a syndication. We're thinking, okay, they're buying shares in this company and they are passive. Switching that mindset about buying shares, buying a security in the company into they are a partner, they're an active partner in this company. And so we're looking for ways for them to do, for all of us to do active work together. They might have limited active work versus the club leader have more active work, but thinking from a perspective of partners rather than active partners rather than buying shares.
Yeah,
Right.
exactly.
Okay. So you mentioned about since the club is structured as just a normal LLC, everybody are partners in it. That means that we don't have to create all the PPM and subscription documents and stuff that like we normally do in a syndication. Is that correct?
Exactly. So the SEC, they don't see investment clubs as securities, so that's why they don't regulate it. So with that, you don't have to create a PPM, you don't have to do a 506B or C filing. But the main thing really just comes down to active participation, right? Like you have to make sure
Right.
you're providing the environment for people to make decisions as a group, like a collective business decision for what the group wants to do for their investment club. And that's why, as a platform, we actually have the senior counsel of the SEC as our legal counsel. And that's how we've built the platform. And we actually track everyone's voting on the platform as well, so that there is essentially like a written trail of how the decisions
Mm,
of a club is being made together.
excellent. Okay. How does the SEC view investment club different than a normal LLC? So let's say there's three of us that partner together on LLC and invest in a deal together versus there's 99 of us in this investment club investing in a deal together. How, from the perspective of SEC, how do those two things differ?
Yeah, that's a great question. I would say in a traditional JV, right, where there's less people, you typically have every single individual taking on a different responsibility versus now in an investment club, it's taking a lot of different people's opinions and then reaching a consensus on the group's decision. And that's why a lot of times you start out with not necessarily a specific deal, but you're starting out with this is our business thesis, this is our investment thesis. And that's where we're all coming in together for. That's how you can essentially run investment clubs at scale, right? Like it's going to be very hard if you wanted 99 people to all take on a different role. But if it's like all 99 of us believe that investing in laundromats is the next big thing and we want to be a part of this, let's form a laundromat club. And then we look at a lot of laundromats together and then decide as a collective where we want to deploy that money. So it's really think about it as like running a JV with a lot more people and at scale. How would you do that? It's with an investment club structure.
I see. Okay. When a syndicator is doing smaller deals that the raise, even a $5 million raise, that would put them to be possibly a 15 million dollar deal, right? Which
Yeah.
is still a sizable deal. What would you say are the advantages and disadvantages of using the investment club model versus a normal syndication model?
Yeah, the way I see it is I don't think you ever need to pick one or the other. We work with a lot of people that run funds and syndications, and then they also run investment clubs in parallel. And the way they think about it is they want to unlock pretty much all aspects of their audience and run it at scale, right? So that's why, Tim, when you mention people with a community or people that, are developing their social presence, for example, right? A lot of times your community or the audience you're attracting, they're not necessarily going to be very wealthy accredited investors or family offices, right? They could just be normal people that have 10K, 25K, 50K, right? Just like a tier lower than what your traditional syndication might be, but value in being able to capture that side of the market and potentially convert them into a syndication or fund down the line. So that's one aspect that we see it.
Mm,
And then the second one, it really comes down to marketing. We've had a lot of very sophisticated operators choose to do an investment club because when they're publicly talking about their club, because it's not a security, right? You have more freedom to talk about what you're doing in the club. It does signal to everyone that consumes your content that you are actively raising money. So people have
yep.
raised 6 to 7 figures for their club, and then because they're marketing their club, they also raise 7 figures for their fund or their syndication. And last week I was talking to one of our clients, Brand Burnham, and he was saying like a lot of people saw him posting on Facebook because he was marketing his club, and they were like, "Whoa, Brandon, we didn't know that you're raising money again. Like, why didn't you tell us? Can we still invest in your fund?" So he wasn't even like marketing for his fund, but because he had more room to just talk about what he's doing with the club, he ended up raising money for both sides of the legal structures. And I thought that was a really cool way to really leverage the advantages that you get from a club and then have it fit
Right.
the different parts of your legal structures.
I like that. that. I like that a lot. Yeah. One of the attorneys that I've interviewed a couple of times on the show, Nate Dodson, he has a crowdfunding platform, RegCF platform, and he structured something very similar to that because with a RegCF, you can advertise, you can talk to anyone, accredited or non-accredited. And yeah, and so starting that conversation then leads, depending on if they're non-accredited, takes them to the RegCF. If they're accredited, take them to the 506C. So it's a similar kind of idea here that you have. I like that a lot. And in terms of like, you mentioned that with the club, you are able to raise money ahead of time before you even start looking for properties, before you even get a property in a contract. So you're raising it based on your business thesis, right? So similar to the advantages of a fund, a blind pool fund where you can do that you can't do with a syndication. I like that a lot. Can you touch on that a little bit?
Yeah, definitely. And I'll share a case study here, which I thought was really interesting. So we recently worked with some of the folks here in commercial I know, investor girl Brittany Arneson. So they are very focused on hotels and self-storage. And at one point, they had found a hotel, set up a 506C for it, and then actually already raised deposits for that specific hotel. And then during due diligence, they realized that this deal was not going to work. So basically, the deal fell through. They built their 506C documentation on that specific deal. Plus, they've already collected deposits from a bunch of people in their network that are just really bullish in general about hotels, right? So they're like, okay, we don't really want to give up this money because we've already raised it. What do we do next? And then while this was all happening, they find hotel deal number 2, and it's got a really tight closing date. And also in the back of their head, they're thinking, if we did another 506C for hotel deal number 2, what if hotel number 2 also falls apart doing due diligence? Now we gotta go make another 506C for hotel deal number 3, and it's just not scalable. And that's when like the investment club made a lot of sense for them, because all these people, they just primarily want to invest in hotels, right? They're not so particular about deal 1 or 2 or 10, right? We just really love hotels. We really want to invest with you, Britt. And that's why they ended up creating a hotel investment club with a specific buy box, right? You still have to be pretty defined on what kind of properties you want to target. So they made the club instead. And then now we can look at deal number 2 and vote to approve. If deal number 2 doesn't work out, you don't have to build another club, right? Your buy box and your club and all the investors, they still stay intact. You just find another deal, look at that, and decide whether or not you're going to deploy money into that. So that's why I think being able to raise money for a criteria, with or without a deal, like not having it tied to a specific deal, is a more strategic approach if you're someone that has a decent amount of deal flow and you have options where you don't need to be tied to a specific project.
I like that a lot. Okay. Yeah. And then share with us one of the things that you touch on when we talked before this interview, your process of requiring the investors to put a deposit that holds them to be able to perform or they lose their deposit. Because one of the challenges that we have in the syndication space with the soft commit is that sometimes they don't go through with the soft commits. And depending on the market, if there's a lot of uncertainty in the marketplace, we see a higher percentage of LPs who soft commit and then back out. And so touch on that, dive deeper into how your platform works and regarding that, and also what are all the fee structure too.
Yeah, definitely. So exactly to your point, Tim, like I got burned myself raising money where people gave me all sorts of verbal commitments and then just completely disappeared out of thin air when it was actually time to wire the money. So I was like, never again. How do we prevent this? And we took inspiration from sellers needing an EMD, right? We were like, why isn't the concept of an EMD more common when it comes to raising capital? So the way that we designed our platform is when someone joins your club and says, I'm going to invest 50K, it's not a verbal commitment. They actually have to pay Fractional's transaction fee, which is 3% of whatever they're investing, as a way to lock in their spot in your club. So then if you hit hit your race target, everyone is good and everything is moving forward. And for whatever reason, that one investor decides to flake and not invest. They're going to lose that 3% transaction lock-in fee that they paid. And nobody wants to lose money, right? So it really enforces them to have skin in the game when they say, I do want to join your club. We ask them, okay, put your words where your mouth is at, right? Leave that transaction fee. So that's really just significantly decreased the flake rate on the platform. We rarely see it happen because people are really committed and they're financially tied, right? When they say, I'm investing 50K, I'm investing 25K, they're putting that 3%. So that's how we've turned a soft commitment into more or less of a hard commitment. And then in terms of how pricing works, so we have a setup fee that is $3,500 for us to basically turn your criteria, turn your deck into a compliant investment club where we make sure you have all the right pieces in play and this isn't accidentally a security and all those things. And then when your raise is successful, that 3,500 is actually credited back to you. It's mostly there just because we're putting in a lot of work to set up your club and we want to make sure like you're actually serious in wanting to run this club. So that's the setup fee. And then when your investors join, they pay a 3% transaction fee off of their investment. And that covers us creating the LLC, building the operating agreement, all the payment processing and money movement is happening on the platform. And then we also do identity verification on all the investors to make sure everyone is who they say they are. So that's what each investor is paying. That's not a cost to you. And then we do everything back office too. I know no one wants to be a full-time CPA or accountant, so you don't have to deal with any of that. We automate all of the profit distribution. So we calculate whenever we have a distribution or there's profits, we calculate pro rata how much each investor should get and we'll automatically send it to their bank account. We file taxes for the investment club as well. And then we also create K1s for every single investor. So it effectively saves you from having to have a full-time accounting team or working with another full-time CPA. That's pretty much all covered in-house by us. And that is $3,500 annually for the entire club. Doesn't matter how many people you have in the club, doesn't matter how many deals your club is doing. It's always a flat $3,500. And usually we see the club leader paying that while the investors pay the 3%. That's one time.
I see. Okay. And on the default, meaning they don't move forward, they do their deposit but don't move forward. Does Fractional keeps that money? Does any of that money goes back to the club leader at all?
It's just fractional. It's effectively
Okay.
they're paying for our transaction fee.
I understand. Okay, that's good. So yeah, it sounds like the process to start your club is pretty easy, pretty straightforward. Fees are minimal. I like how the bulk of the fees is charged to the investors itself. So that way the club leader doesn't look like their club is very fee heavy. Yeah. Okay. Very good. All right, Stella, I know I put the link to your website on the chat, but for those that are listening to this on audio, if they want to learn more about Fractional, maybe reach out to you, whether to interview you or do collaborate with you somehow, where would you like to send them?
Yeah, let me drop my Blink card in the chat as well. That way everyone has my information. That's my Blink card. And then my email is just stella@fractional.app. Super simple. Tim dropped our website, fractional.app. Definitely find me there.
Great. Okay, real quick before we open up for Q&A. I know you mentioned to me previously you raised about 20 million for Fractional. Share with us, how did you do that? Who did, was it all VC money? Was there any sort of friends, family money? Give us an insight into what it's like to raise money for a startup.
Yeah, it was honestly a very chaotic yet fun experience. So we started Fractional January of 2021. So we officially pretty much just hit our 5-year milestone, which is very big for me personally.
Wow,
And
congratulations.
thank you, thank you. So we started out as a Y Combinator company. So Y Combinator, they were the first check into the business. And it's a very big deal for any startup founder because YC basically created all the legendary businesses out there, right? Airbnb, Stripe, DoorDash, all of them came from Y Combinator. So they were our first check and it definitely helped a lot with just giving us more visibility, all that. And that's actually how our council found out about us. That was also a very interesting experience where I randomly got a call from Zach, who was the former senior counsel of the SEC, and he was like, "Hey, it's Zach. I'm from the SEC. Give me a call back." I literally thought we were in huge trouble, but luckily he really believed in what we were doing and now is our legal advisor and helps us and all of our clients be compliant. So that was a very scary moment, but turned out for the best way possible. I always love sharing that story. But yeah, from YC, we started building the initial MVP. We launched, I think, 10 clubs initially within the first 3 months of starting out the business. And then demo day is what YC does, where you basically come out, you pitch a room of 100 VCs. Think about like Shark Tank, but in real life, essentially, right? And if people like you as a founder and they like the early traction, they'll decide that they want to be seed investors in the business. So we, at first, on top of YC, raised $5 million from CRV. They led DoorDash's round in the past. And then also Will Smith and Kevin Durant. They really loved like the whole community aspect that we were building. So they joined in that round. And then from there, we built a team. The business started growing even more. And then more recently, we raised $15 million for our Series A from Fifth Wall. They're the largest VC in real estate. So it's been like every day is very new. There's always more things to work on. I always say like myself and the business, like we're always a work in progress. And I am like always just so fired up, even as an investor too, like seeing all the cool projects that everyone gets to work on. And sometimes it's fun to double dip where I'm like, whoa, that looks really cool. Can I join your club? So it's been an incredible experience.
That's amazing. Congratulations to reaching 5 year and definitely all the success you have had so far. It's amazing.
Thank you.
Yep. All right. I really appreciate you, Stella.
Of course. Thanks for having me. That was a blast. Appreciate everyone here.